I continue to view that probably the biggest thing to focus on is U.S. fiscal deficits. I think that for years, I mean, during the whole pandemic and even after the pandemic, that has been an underappreciated topic in macro. It's increasingly understood, but I still feel like it's not fully conceptualized by a lot of market participants. Basically, the U.S. is now in fiscal dominance, which is to say a couple key things. One is that public sector deficits or public sector debt creation is now larger in most years than the sum total of private sector debt creation. So if you add up net new bank loans, net new corporate bond issuance, and even estimates of less liquid private credit deals, that whole arrangement is generally smaller in a given year than total federal deficits that year, total federal treasury issuance. And so the reason that's relevant is because the Fed's main tool for trying to either accelerate inflation and credit or decelerate inflation and credit is interest rates. Um, and so when they raise interest rates, they can generally slow down the rate of borrowing by making borrowing less attractive. And if they want to accelerate borrowing, they can lower interest rates and therefore try to provide a boost. The problem is the federal government's not really interest rate sensitive. A lot of their things are just locked in. They're going to borrow regardless of what interest rates are. And so the Fed's tools are less effective in a fiscally dominant environment. And if it gets extreme enough, it can actually be pro-cyclical in the sense that higher interest rates make federal interest expense larger and therefore increase the size of the deficits, which can be stimulating in some ways. And so it's a very different macro environment than has been the case for most of the past 40 years. We've been in fiscal dominance. Early stages was like 2018, 2019, but really more recently in a cyclical sense, the 2023, 2024, and still in 2025 period has been characterized by fiscal dominance.